There's a good there's a good possibility of a market pullback in the near future. I didn't say this. This is coming from the CEO of Goldman Sachs and the CEO of Morgan Stanley. Goldman Sachs said that in 1 to 2 years, we could see 10 to 20% market pullback. So that's not saying something to scare you. That's saying something to prepare you. Hey, you like what I did there? All right. So let's take a look at this chart here. This is macrotrends.net's chart showing the S&P 500 all the way back to 1930. I really want to focus on 1940 to today. Look at years where we've had a large run up in the stock market and then what happens after those years so that we can understand. And then I'm going to teach you how to prepare for this, especially if you are near or in retirement. This is focused on you because you're going to be able to develop a strategy that can help just to mitigate the emotion risk that you're going to have when you have a pullback in the markets, as well as mitigate the risk of actual sequence of returns where you're pulling from a downturn in the market or a bucket of dollars that are down during that time. So looking at this chart right this second, you can see that we have a lot more green than we do red. We understand that, okay, the markets go up more than they go down, but there are times when they go down, and sometimes it's a small pullback, sometimes it's a large pullback, as you can see in this chart. Looking at this, though, and kind of breaking this down a bit, let's go back all the way to 1940. And what's going to end up happening in 1945, we had a 4-year run. And in that 4-year run, we had a 76.4% return. In the following year, what happens? We had a negative 11.8%. And then we had a 0, and then we had another negative 0.65%. So that was during that period after a solid 4-year, what you would call oftentimes, and they talk about in the markets, a bull run. Then we go down to 1952. In 1952, we had a 4-year positive return, 60.28%. Then the following year, a negative 6.62% there. After that, we come back again. We have a strong 3-year return of 74.04%, then 14.31 drop. Now, I could continue this forever, and I know you're like, geez, can you just get to the point on this? You're understanding that there's going to be pullbacks in the markets, and there's going to be times where this happens. Now, if we fast forward just a little bit and we actually look at more of current data, let's just not look at the 40s, but let's start to talk through the 80s, which were an amazing time when it came to the markets, though we had a lot of inflation going on during those times. And we've recently seen a lot of similarities with that because we've had a lot of inflation that's affected us, not only from, a financial standpoint with the markets, but also for our personal wallets. And we understand that more than anybody right now. Going back to 1989, there was a 116.06% over 8 years, then a negative 6.56 pullback. But then after that pullback, we again saw a 131.58% over 5 years, then the dot-com bubble, and also we had the 9/11 terror attacks. Time where we saw a 46.55% pullback over 3 years. Then going into 2007, we had a 5-year run of a 55.52% return, and then again dropping 38.49%. So we're getting into now more current times, more current events, and understanding that it, again, goes, whether it be 2, 3, 5 years, possibly a little bit longer than that of a run, and then there's always that pullback. Now, the most recent ones, we know of COVID was a big time there. We're looking at that. We look at, there was the pullback during COVID, but actually COVID was a positive year, which is interesting there because in 2018 was the last pullback prior. So we finished negative in 2018, but post-COVID during 19, 20, and 21, we had a 3-year run of 72.03%. Then in 2022, as that is the most recent pullback that we have really seen that's significant that ended in a negative year, we had a negative 19.44% as it stands today. Now, granted, the markets will shift around a little bit. I'm going to give you a baseline number here, though I don't want you to quote me on this because it could be roughly off. We've got a 3-year run right this second. We had 24.23% in 2023, 23.31% in 24, and then as it stands today, possibly, depending on when you're watching this, it was around 16.38%. We still have the rest of the year to go, so we're at 63.92%. So we do have a difference in where we are in current markets versus where some of these were, because some of them If you remember, I just mentioned we're over 100%. But again, we are on this 3-year run where there's a 3-year positive bull run with the markets where we're looking at things and saying, wow, 20+% years. How long can this sustain? That's where Goldman's CEO, Morgan Stanley CEO, and others are starting to talk now about the potential for a pullback, while others are screaming the B word. No, it's not that. You can let the kids still watch. It's the bubble. So we've got to watch out for the bubble in this and make sure that that's not what we're leaning on. But how do we protect against it? What do we do? Well, I've talked about this strategy multiple times, and this is what I'm really passionate about because I've been able to help clients do this and effectively work through times that were really tough for them. But in the end, they came out on top and they felt okay because they had a plan in place. And that's part of it, is just making sure that you have the plan in place. When it comes to that plan, though, I lean towards having a 2-bucket approach. I call it the 2-bucket Powell method. Not really, that's my last name, but I just made that up. And so we've got a conservative bucket over here and we have a growth bucket over here. Now, during these times, what's going to end up happening is you're going to have roughly 5 years of income needed in a conservative bucket. What's that conservative bucket made up of? It can be money market if money markets or high yield savings accounts are paying what they've been paying, which has been well over 3% recently. You could have short-term bonds. You could have some long-term bonds, but you do have to be careful because they could fluctuate significantly. And you do also have to watch out for interest rate risk, which we saw in 2022 using bonds in general. But having that conservative bucket there is a nice piece of the pie. And then on the other side, you have the growth bucket. The growth bucket's not a number of years, it's the remainder of your dollars. Those should be for growth. And when you're doing that, yes, you're going to be diversified. You don't want to just be in one initial sector or one stock or anything like that. Have a large, broad array of stocks that you're using. And when the markets are going up, you're going to live off of the growth. That's what's going to happen. But when the markets are down, it gives you the ability to allow the markets to recover by pulling from the conservative bucket. It sounds really technical. It is not, though. Believe it or not, though, talking with some other large financial firms, it is not common practice. And the reason for that is it does take work on the back end. And when you're doing this, if you're doing it at scale, it's very difficult to do. I do this and am able to look at it on a quarterly basis and customize this for clients to be able to make sure they're doing that. But if you're doing it for yourself, it's just going to take a little bit of work. But would you rather have the work and the peace of mind or not have that at all? So that's my theory there and my strategy of what I'm doing for clients and something I'm just sharing with you to hopefully help you get through these times. So if you have any questions, if you're looking for an advisor, you know where to find us. But if not, I hope that you weather the storm when it comes to the markets. You're going to have a lot more upside than downside is what we've seen historically, but just make sure that you're prepared, not scared.
We all want more. Let's open the door. Introducing the Dose Score.